Peter McGuire, CEO of XM Australia. Thanks everybody for joining us today and trying to sort of unpick these dynamics in this now increasingly volatile market, many would say. There's our bulletins for the day. And we just had the survey question about what kind of premium the global spare oil capacity of 5 million barrels a day has trumped geopolitics premium risks and pushed prices back into the 80s. That's our result from yesterday. Most people disagreeing with that spare capacity isn't trumping geopolitical premium risk. We'll have a talk about that a bit later. Peter, good morning again. Let's go to China. Let's go to Asia and hop across there. Another headline in the news yesterday that China's pledging a new stimulus. I think I have a figure here of $140 billion equivalent. Is that having much sort of impact again on sentiment or reality on the ground? We had somebody on the podcast yesterday who was pretty positive about China going forward, and that it's not as weak. It's not going to be as weak a story as we've been talking about for most of this year.
Well, Dyala, lovely to join you from Sydney. You know, if I look at the market today, it's just only down 0.06%, the CSI 300. So it really hasn't, considering that you've got other markets down 2% and so on with Indonesia, then the Chinese market is probably in good stead. But when you're looking at that, I mean, the overhang, one can't get their mind away from the property sector. So how much do they need to prop it up? And still the talk is, you know, you've got 90 million apartments or homes that are uninhabited. So you've got serious overhang. Who's holding the debt? We're conscious as far as domestic banks, but more importantly, international banks, about 120 of them that are holding that debt. So that's going to be a work in progress, how that all materializes, certainly in 24. I think you know, the storyline's got to be domestic demand, and because naturally it's pretty weak everywhere else as far as demand picture, inflation's still biting hard. It's, you know, ratcheting up of rates and cost of living expenses and the cost of oil and all of that to Main Street, the impact it's having to the man and woman on the street. So if the domestic demand, Dyala, can get a rocket ship behind it in as far as China's concerned, then that's going to be a good move, and they need to get their domestic market going well. And it's just going to be a work in progress to see if that materializes and happens before, say, Lunar New Year, and how the roll-up's going to be, you know, by end of January. If it's not there and it's still functionally weak, then that's going to cause more concern, and naturally they'll have to stimulate far harder to get a bigger result.
Peter, let's talk a little bit about the commodity barrel, if you like, beyond just oil. Where's the sentiment there in terms of commodities, tracks and indicators? Has the Middle East war pushed the story further that we're going to be risk on for commodities in general with potential disruption going forward? Has there been any change there in the last couple of weeks?
Well, first off, I'd like to say the US dollar index, we're nearly at 107, Dyala. Now, we were down at about 105.50. It's been very, very choppy. You've got a yen sitting above 150 now to the dollar. You've got a euro sitting the best part of 105. 1.0534. And we had a very hot read as far as inflation hitting Australia. And we were thinking you might see a 62 handle. We're at 62.87 Aussie dollar, US dollar. So that leads me to the next point, which is gold. We're at record highs in Australian dollars as far as gold, and many other currencies, I believe nearly into the yen as well. So gold has had a dramatic move. And, you know, earlier this month we were away. We saw that, you know, I was with you, and, you know, the gold cratered and it hit 18.15, and everyone said, oh, its best days are gone and all of that sort of stuff. And well, it's certainly rallied and rallied strongly, because you're just sitting under $2,000 now. So there's the first part. Base metals have been flat. They've been punched and punched hard. You know, the likes of copper still at that 8,000 a metric ton. So the demand picture there for base metals has been poor. Iron ore is going okay, but nothing like it was. But the overall theme, I think, has got to be precious metals have just been on fire, and that US dollar's carrying everything. And, you know, the smart money has all been on, if you're a trader, you've been looking at where you're getting movement, and that's been certainly gold and certainly crude, because they've just been blowouts. You know, you had that 95 down to 83 or 84, and then boom, back up. and you're at 90. What are you at now? You're at $90 now on Brent, just under, and you're at 84.5 for NYMEX for WTI. You know, they're just big blows. They're $2 and $3 moves over a couple of days, and that's what traders love.
And I mean, in terms of dollar trajectory, you know, we've now had the sort of new interest rate norm, if you like, settle. Everyone's agreeing it's 5, it could go up a little bit more, etc. We had some comments earlier this week from the likes of Jamie Dimon about where treasury rates could go in terms of interest there and prices dropping a bit further. But how much, further have we seen sort of the dollar almost peaking, would you say, because of that? Because, we're not expecting any more interest rate increases in the US, and we're going to see it steady as she goes from now on. What would you put your money on in the year to come, let's say?
Well, if you're saying where is it in a year's time, I think it's up from here. It's at 106.80. I think by the end of the year, I won't be surprised to take a 108 or 108.20 handle out. So that's the momentum to the upside. And I think the reasons for that is because of yields, and you've got that cratering, as Artie said, as far as, the numbers coming out of Germany and out of Eurozone are poor. So there's the first part. So I think the flight to safety is going to be US dollar, and that seems to be gathering momentum globally as far as traders. Everything else is being sold off. And equities, I won't be surprised to take another hit to the downside for NASDAQ and all of that, which is, they had a big hit last night. So I think the overall consensus is dollar up, hold on to your hats, possibly gold to rally up. Have a look what's happened to Bitcoin in the last couple of days, 34,500. And you've got to say there's a sense of nervousness on Main Street and certainly on Wall Street.
Yeah, a rush to sort of say the alternative safe havens, I guess. Bitcoin's coming back into fashion, at least for now. Peter, I'll just go to you just to talk about gas a little bit for Asia, but in the context of Europe as well. I mean, we've just heard Adi's comments on oil, but we had somebody earlier on the program this week saying that, gas in Europe is looking very relaxed in terms of the market. Premiums against spots are pretty low, for even into the first quarter. What's the picture in Asia in terms of gas supply, gas premiums, risk there? Europe is a bit more comfortable this year going into winter than it was a year ago.
Well, exactly. That's the sort of the storylines that I've been reading, and it's making a lot of sense. After reading it, I was quite surprised because it took me, it said, February, March, there's really no issues as far as, across the European frontier for gas. And I was thinking, well, a couple of things that really sprung to mind were the Chevron issue and out of Western Australia, and they had those union issues only going back to the start of September, and then they seem to have settled down, and then they flared up again, and now by the looks of it, they've settled down. I think there's 2 fields there, Gorgon and the other one. I'll think of it in a second. And so that was a good point. And the overall, I think, obviously from a supply side, if there's not any issues, then that's going to be good for a European winter. And our exports, because we provide about 20% of the world's production, I think Qatar's 21% and the US is about 19% or around that. The 3 of them, they're the first, second and third. And as far as Asian demand, that seems to be fairly as strong as ever, considering Japan and the situation across a number of other Asian nations. So I think that's a good point, and that's good. We don't need to see, because that was always consensus or a troubling thought putting your mind back a year ago, Dyala, that there's going to be mayhem across Europe. There's going to be no gas. Well, at the moment, that doesn't seem to be an issue. So let's just hope that it's a mild winter from a weather perspective, and they're not going to have any issues as far as, getting supply.
Thanks very much to Maliha, Adi, and Peter today for joining us on the podcast. Thanks so much, everyone. Have a great day.
Thank you, Dyala. Bye.